Okay, so we're going to look at how to report inventory in the financial statements. And there's a few accounting principles that apply to how we report merchandise inventory. So the first one is consistency. Consistency says that you have to use the same accounting method year after year so that we can compare financial statements from year to year. So we're going to see with inventory, we're going to have a choice between 3 different methods that we can use for calculating the cost of our ending inventory. And a business can adopt one of those methods, but then after they use that method, they have to stick with it. They can't bounce back and forth between the different methods. As we're going to see, the method that you choose for reporting inventory is also going to affect what you're showing for net income on your income statement. And so we need to choose a method and stick with it so that we can be comparing our income statement from year to year and see, why it's changed from things other than changing your accounting method. The disclosure principle says that we need to provide enough information so that our users of our financial statements, our investors and creditors, have enough information to make their decisions. And so we're going to see we need to tell in the notes to our financial statements which inventory method we're using. So we've got our financial statements, and then following our financial statements, we have a series of notes that provide additional information. Materiality concept. So this one's a little bit strange, but a company has to perform strictly proper accounting for significant items. Okay, so when we're talking about materiality, we're talking about the relative importance of an item. So usually it's a dollar amount. So the example they're giving here, if you have sales of $100,000, $10,000 is a material amount. I know $10,000 is a material amount to me personally. However, if you think about your financial statements for your financial analysis project, the company's rounded their numbers to millions. So 6 zeros were left off. So $10,000 doesn't change anything. It's not even a rounding error in a company with that much revenue, a company of that size. And so when we are needing to be specific, we have to be worried about if the amount would change the decision making of the person reading the financial statements. And then we have conservatism. So conservatism means if we have 2 different choices, when there's an uncertainty, we have to choose the method that is going to not overstate our income or overstate our assets. Okay, so we're going to see between the methods we have, there's 3 different methods. One of the methods is going to most likely give us the lowest inventory method, and that's fine because this is an accepted method amongst GAAP. However, when we are not sure what to do, we can go one of 2 ways. We go the way that's not going to overstate income or assets. Another thing, when we're talking about we're talking about inventory, control over inventory is going to be really important. So when we were talking about merchandising operations back in Chapter 5, we talked about inventory shrinkage, right? And that companies have losses due to inventory shrinkage. So inventory is going to be vulnerable to theft and fraud. And so we want to make sure that we have things in place to safeguard the inventory. Another thing we're going to see is inventory has a big effect on both our income statement and our balance sheet. And so we have to make sure that we're recording it properly. So some of the things when you are safeguarding your inventory, protecting it from theft or fraud, one thing is you want to limit access to the inventory. You don't want anyone to just be able to go into your warehouse and walk out with inventory. Another thing, another area is when you're purchasing your inventory, you want to have controls or safeguards in place. So for one thing, the person that does the purchasing for your company, they will prepare a purchase order, okay? And somebody should authorize the purchase order. They should get permission. Okay? And then when the inventory gets shipped, someone should be in charge of receiving the inventory, and they should prepare a receiving report. And that person should have to count out what you received in the shipment. Okay? You shouldn't let them know what was ordered, because then they may not count it. They'll just sign off. It's easier to say, okay, that looks like 100 cases. That's what we ordered. You want to have them count it out. And then in accounting should get the purchase order that says what we were authorized to purchase. They should get the receiving report that says what we actually got. And then they get the vendor's invoice to see what we're being charged for. And they need to make sure that the receiving report, the purchase order, and the invoice all agree. Okay, so again, other security measures that we want to have in place. We want to limit access to the inventory. High-priced inventory should be restricted further. And then using two-way mirrors, cameras, security tags, etc. to watch your inventory. So when we are reporting inventory on our balance sheet, in order to assign a cost to our inventory, we need to count up our inventory to see how much we have. So we'll take a physical inventory. The physical inventory might be done periodically throughout the year. The big physical inventory is going to be done at the end of the year. After we have determined the quantity of inventory, then we are going to assign a cost, a dollar amount, right? Because on our balance sheet, we're not going to show how many units of inventory we have. We're going to report the dollar amount for those units. So we need to assign a cost, and we can follow a cost flow assumption. So the cost flow assumptions may or may not be the same as how the goods actually flowed through the company. So one cost flow assumption is that the costs flow in the order in which the costs were incurred. This is the first in, first out method. So when we get inventory, we put it in our warehouse, and when the next shipment comes, we put it behind the first order. The next one goes behind the second order, and we pull from the first things that we received. So the first things we received are the ones that we sell. And that's probably a common way that the orders are filled. But your orders don't have to be filled that way in order to use FIFO. Okay. The next method is LIFO, last in, first out. So cost flow is the reverse of how the costs were incurred. So LIFO sounds kind of strange. So you get a shipment in, you put it all the way in the back of the warehouse. The next shipment comes in, you put it in front of it. And then as shipments come in, the newest ones are in front, and you pull the orders from the front, right? And so that, in a lot of cases, would not be how you want to fill your orders, because that would mean that you would have items sitting in the back of your warehouse for a long time. If we sold the last ones that came in are the ones that we used to sell, the earliest ones could be sitting there for a long time gathering dust. So a lot of companies wouldn't move their inventory according to LIFO. But that doesn't mean they can't use that as their accounting method, right? Accounting is being done in the corporate office. They don't know how the people in the warehouse are filling orders. So you can choose an accounting method and your goods don't have to flow that way. Or you could use what's called weighted average or average cost, where you take an average of what you've paid for all of your items and use that to assign a cost to inventory. The fourth method is specific identification. And specific identification is when you can look at an item in your inventory and you know exactly what it cost. You know what you paid for it. So not a lot of companies can do this. Usually it's going to be if you have a higher price or a very unique inventory. So the examples they have here: automobile, artwork, jewelry. So a jewelry owner may be able to look at a necklace and they know exactly what they paid for it because it's very different from other pieces of jewelry that they have. Okay, but companies that sell a large amount of items that all look the same isn't going to be able to use specific identification. So we're not going to spend time on specific identification. We're going to look at the other three methods, and we are going to be focusing on the periodic inventory system. So when you're looking through the chapter and you want to be reading and learning about the terms, such as the principles that I talked about, but the calculations for the perpetual method, you don't need to spend time on. The periodic calculations are covered in the appendix to the chapter, and that's what we are going to be focusing on. So I'm going to use this example. Okay, so we've got our beginning inventory, 250 cases that we paid $23 for, and there's the total, $5,750. And then we had a series of purchases during the period. Okay, here's the cases, here's what it cost per unit, here's the total amount. If we take our beginning inventory, we add our purchases, that tells us what we had available to sell, right? What we started the period plus what we bought is what we had available. So here it is in cases, here it is in dollars. Okay. Whatever we have available to sell, either we sell it or we still have it. So we sold 1,000 cases, so that means we should have 350 cases in ending inventory. And we're going to assume that we went and we counted up our ending inventory, and that is, we actually have the 350 cases. But we know we're not going to show for merchandise inventory 350 cases on the balance sheet. We have to put a dollar amount. Okay. The first way we can put a dollar amount is average cost. Average cost, we're going to take two steps to assign the dollar amount to inventory. The first one, we're going to calculate the average cost per unit of inventory. So we take the cost of the merchandise we had available for sale, we divide it by the number of units available for sale. That gives us what we paid on average for one unit. So then step 2, to calculate the cost of ending inventory, we're going to take that average cost per unit, multiply it by the number of units in ending inventory, and that's going to be the cost assigned to our ending inventory. So here in our example, beginning inventory plus purchases is what we have available for sale. So we have 1,350 cases that cost $36,550. So if we paid $36,550 for 1,350 cases, on average, what did we pay for one case? So we can divide and see on average, we pay $27.07. So our cost of ending inventory, we're going to take the $27.07 and multiply that by the 350 cases we have left, and that will tell us the cost of our ending inventory is $9,475. So that's what we would be showing in our merchandise inventory account, and that would go on the balance sheet. Now if we look at our income statement, we had $36,550 available for sale. If we subtract our ending inventory, that gives us our cost of goods sold. Whoops, hold on. We take our sales revenue minus our cost of goods sold, that gives us our gross profit. Subtract our operating expenses, and that gives us our net income. So we can see if we are using average cost, our ending inventory is $9,475, and we'll have net income of $22,925. We want to look at how we would compute these things under FIFO and LIFO.